So guess what? I invested $15,000 into an application as an angel investor, and this app has gone on to win the Google Play Store App of the Year. Before we dive in, let me drop a bit of a bombshell on you. Did you know around 70% of angel investments result in a loss? Yes, even the best angel investors in the entire world come up short. Investing, especially angel investing, is not a walk in the park. But hey, that's why we're here today, to navigate this exciting, unpredictable world of startups and investments together and spill everything I've learned along the way. This thrilling journey has had so many ups and downs, and I'm going to talk about all the good, the bad, and the ugly, and primarily the three main key takeaways I learned from investing in an application. Number one is you're investing in the founder, not the business. So whether it's a founder, a co-founder, or a team, you need to understand and know if they have the vision and drive to keep building this business over a 5 to 10 year period. Because during this 5 to 10 years, if they don't have the vision, if they don't have the motivation to keep building this, then things are going to fail. A lot of times these startups don't make any money or any big profit in the early days, so they need to stay motivated just by the idea and outcome of building something big that's going to impact and also potentially have the position in the future to make that big payday. You need to figure out, do you trust the founder and have they had previous success? A lot of times first-time founders are a little bit harder to invest in because they don't have any track record. But if every single business this founder has gone through has been successful, and maybe their first one was a multi-million-dollar payday, and they've been able to replicate this same process 2 or 3 times, you're going to have a much higher chance of investing in somebody like this who's already gone through the process of raising capital, building a business, and scaling a business that can be acquired and actually make a big impact on a large market. Lesson number 2 is understanding the full scope of the application, how it's going to be monetized, and how long is that trajectory to actually making money. Most investors want to invest in applications that are going to bring an ROI, and a lot of times applications have the wrong thought process about only acquiring users at a very high pace. But a lot of angel investors don't want to invest in those types of apps because they're more concerned about how it's going to be monetized. So understanding the difference and the different approaches, the primary approach to make money, or is it to just acquire users at the right cost? Because you're going to need to have a lot longer runway if your only focus is acquiring new users. One of the things you can do is ask, how long is your runway at this investment cap? And if they only have 3 to 6 months of runway, they're going to need to go through a lot of different raising funds to bring on more capital and to bring on investors. The other thing you should be asking is, who else is investing in this? Because you really need to understand the team, the vision, and essentially who's going to be working on the application. One of the things about this app is they've outsourced a lot of their development, which has given them a lot longer runway for development. So for example, 1 month in the United States is probably 6 months overseas in Asia or Ukraine or something like that. Your dollar goes a lot further and your runway expands a lot. So understanding all of these things before you invest is going to be extremely important. And lesson number 3, how big is the TAM, the total addressable market? Depending on what type of angel investing you're doing, you usually want to have a big TAM, meaning that this application or this product has a wide use. Something that's very niche is going to be a little bit harder to invest in. It can still be a very profitable business, but it's not usually the right path for angel investing. Angel investing is things like Instagram, Twitter, LinkedIn that can impact millions and billions of people around the world. So does this application have that use case where it can essentially be built up into a large enough user base that people all around the world are utilizing this application, or millions of people in a country? So if you're able to figure out the TAM, that can tell you a lot more about, is this business have a good projection to, 1, make it big enough so they can actually be worth millions in the future, or 2, be acquired by some of these bigger tech companies that want to buy these businesses as they're on their way up. So in conclusion, none of this is financial advice. Make sure you actually follow all 3 of these tips, and there's a dozen more things that you need to look out for before angel investing. And one of the things I want to leave you with is any type of investment, whether it's the stock market, whether it's crypto, or investing in an angel fund, you got to understand, especially with angel investing, your return on investment might not come out for 5 to 10 years. And looking at those initial statistics, the best angel investments are failing around 70% of the time. So if you learned one thing in this video today, make sure to smash the subscribe button, because I'm putting out new videos every single day. And if you've invested in apps or you have some advice, make sure to leave a comment below and let me know what you think.